everyone. Rob, we're joined today by a great guest. He is the current SVP of Operations and Sustainability at Betterment. He's also a fintech advisory committee member for FINRA. We're here to talk about ESG and socially responsible investing. We know Betterment has come out with some great features and portfolios around this emerging investment strategy. So without further ado, Rob, I'd like to introduce our guest, Boris Khentov. Boris, welcome to the podcast.
Happy to be here. Hello. So as we usually do when we start off, could you just tell our audience a little bit about your background and, what led you to your current role at Betterment, and maybe a little bit, about your role working with FINRA as well? Sure. Just a quick context for Betterment, which is the first and largest independent financial advisor that offers automated wealth management services. We're managing something like 33 billion today for about 700,000 clients, both direct to consumer as well as we do work with advisors who use our platform in the Betterment for Advisors lane. We also have a 401k business where we offer managed 401k services. I've been at Betterment for 9 years, actually. I started here early 2013. It was a 15-person company. I was, came in as basically an operations and legal department, all in one person. My background was, I started as a software engineer, as a computer science major, did that for a little while out of college. Then I went to law school, wound up practicing corporate tax law for a few years. Mostly, taxation of capital markets transactions, debt equity for large, sort of blue chip type issuances. And so when I got to Betterment, I really, at that early stage, I wound up doing a whole lot of stuff because I was familiar with, reading dense regulations. I wound up getting pretty deep into the SEC FINRA world, just as Betterment was scaling out our trading and custody operations. Because we are both an advisor and a broker dealer. And that automated stack that allowed us to offer and democratize really portfolio management at any balance size, have our algorithms, effectively deliver value across, whether you have $1,000 or $1 million invested with us. That part of the business, the broker dealer, eventually became the area where I was most active, and so in connection with being now the CEO of Betterment Securities, which is our broker dealer subsidiary, I worked with FINRA quite a lot. First in the context of annual cycle exams, and then eventually we started talking outside of that delightful context and more towards emerging issues and policy. And I continue to work with those folks really closely on the FINRA's FinTech committee.
Speaking of emerging issues and policy, let's dive right in here to what we're talking about. I want to get some definitions kind of correct here, or give our audience an explanation of what ESG is, what SRI is, what sustainability investing is. So we're kind of on the same wavelength here. Can you kind of give us an explanation on the different terminology in regards to ESG?
Yeah, boy, that's a tough one. I think part of the challenge here really is that these things mean so many different things to different people. Mm-hmm. ESG, and a lot of this terminology sort of comes out of the institutional space, right? It's not at all, it does not have its roots in the retail space. So something like ESG, just all these acronyms, right? You can just tell that this is like, I like to joke that it's kind of like, it sounds like a bunch of Belgian technocrats talking to like a Norwegian sovereign wealth fund, about like impact and scoring. The reality is that, of course, ESG. I'm sure most people are familiar, like that. The E stands for environmental, the S for social, the G for governance, and so it's really this attempt to capture, in a single magic number, the good things.
Yes,
and I'm sure, if we want to get into it, we can unpack all the myriad of reasons why that's a problematic approach. It can be very challenging. Sustainable investing is a much newer term, and it tends to be favored by in the retail crowd, sort of like when you're talking to the public at large, because sustainable actually, resonates emotionally. It's what people want. People don't want ESG.
Right.
people don't know what ESG means, but people want everything they do to be sustainable. Particularly like, not to get too cliche about it, but when you're doing the generational analysis, like, I don't know, Morgan Stanley put out a study, something like 99% of millennial investors would like to invest sustainably, right? So like, who wouldn't? Sounds great, right? SRI, socially responsible investing, in a way sort of like bridges the gap between this like technocratic acronym world and this like emotionally relatable, actually human readable type world. It is, however, a slightly older term. It has its roots in actually, the apartheid movement, the anti-apartheid activism of the 80s, where, divestment from South African businesses that were propping up apartheid, these really noble roots. And they do tend to, there is a strong correlation to specifically divestment, which is a practice, where you like just blanket carve certain investments out of your portfolio. That is not at all the whole story, however, when it comes to sustainable investing. So at Betterment, we use the term socially responsible investing because it does kind of have that lineage, and it does resonate with people in terms of what people want to be responsible. But it's sustainability is kind of is the umbrella term du jour.
Yeah. And, I think it's really important for our listeners, a lot of accountants who are thinking about maybe getting into the advisory world, to talk about the benefits of starting to get up to speed on the news of some of these things that are coming out and the growing demand that you just talked about from, some of the millennials. Here at Arrow Family Office, we've had conversations as that SRI or ESG has started to kind of broaden, where people have come in to say, well, are we doing any of that? Or we've had people that have come to us and said, we would like to do this, especially millennial generation, to say, look, my parents invested in Exxon forever and ever and ever, and they made a lot of money. Those people truly believe that there may be an Exxon that's sustainable in a different type of thing, clean energy or what have you, and say, well, I think it's a business opportunity because I think that's the way of the future. And they've come to us kind of asking for it. And what we found to be really beneficial is that Betterment has done a lot of legwork to put a very thoughtful framework into that for us to give thoughtful portfolios to our clients for that demand. Can you just talk a little bit about the demand that you guys are seeing from the Betterment side for these products?
Sure. So we launched our first socially responsible portfolio in 2017, actually, and that was very much in response to what clients were asking for. Clients were coming to us and were saying, "Hey, we would like our investments to reflect our values. We want to invest sustainably." Now, even now, much less then, you would get pretty different answers when you asked, well, what do you actually mean by that? Some people, you touched on a few of these, right? Some people think that, investing sustainably is effectively alpha, right? That you can identify something that somehow the market is not pricing in, whether it be, companies that are, if they have better, labor diversity practices, well, eventually in the long term, the market will reward those versus their competitors. The quarterly earnings don't reflect that, something along those lines. Even more, I think, dramatically, right? The transition to a net zero, carbon economy. Not everyone can fully anticipate and bake in the extent to which regulatory shifts will potentially strand assets, devalue assets that are, and that this will all happen in a nonlinear fashion, right? That you're not going to get necessarily kind of a gradual, oh, okay, well, these stocks are on the decline. These are on the suddenly we'll just have a ton of regulation that will just dramatically impact the valuation of these things. So there are kind of like investment heavy approaches. And then there's, values based and really just like a feeling of wanting to be a part of something or to not be a part of something. There are interesting lanes opening up around shareholder activism, where this is a form of sustainable investing that actually has nothing to do with what stock you buy or don't buy. You buy them all. It's what you do with the shares, and whether you support or initiate shareholder activist campaigns that push towards sustainability goals, like Engine Number One recently did with Exxon, which is a pretty famous example of that. Really put it on the map. So over the years since 2017, we continued to iterate on these offerings, and we were very transparent with our clients early on. And I think this is really key now as much as then, is to be very clear that this is a very nascent, evolving space, that there is no perfect solution, that this is a process, and that it's really important for clients to tell their advisors, hey, this matters to me. I'm not sure exactly necessarily, I don't have to know exactly what it is, but investing sustainably matters. And then the advisor on their end can say, well, I have done some research and I understand to some degree, what this is, what this isn't, what the various, considerations are. But I too don't entirely know what this is. But now that you have told me as my client that this matters to you, I will now on your behalf continue to work on integrating your preferences alongside the core investing mandate of making you more money. This is investing, right? This is not, first and foremost, sustainable investing is not about changing the world, it's about investing. That's really important, and most clients do appreciate that. So, I'll stop there for a second, but I think that transparency, that this is a work in progress, is key. And I think clients respond really well to that.
Yeah, speaking about transparency here, Boris, I was fascinated by your guys' new ETF, Vote ETF. And I know we talked about the anti-apartheid movement and about divestment, but can you kind of touch on this Vote ETF and the push towards promoting an economy that's more sustainable, and how shareholders can vote and really produce change from inside a company?
Sure. So I touched on divestment as this kind of like venerable practice that has really noble roots and has a lot of application when it comes to, say, fossil fuels, decarbonization of the global economy. But there's also this concept of engagement, and divestment and engagement are sort of kind of a yin and yang. They work very well together. And while purists may kind of argue that it's really just all about one versus the other, we believe that there's room for both. That it can be very powerful, especially symbolically, when a large pension fund, someone really kind of high profile, says we are pulling out of all fossil fuel stocks. That creates news, and it creates, it shifts the public discourse, and eventually leads to laws, new regulations. But we also know that anything that remains profitable and legal will continue to be funded. And the more that, that the cost of capital is increased to these activities, the more profitable this investment actually winds up becoming to the people who are unscrupulous about that activity and who will invest in it nevertheless. So there's it's kind of like almost like a savage
balancing act
where, as long as the thing is legal, someone will finance it. And so divestment is important because it sets the foundation for eventually changing the laws. But in the meantime, there's also a way to directly alter the course of a business's activities via using shareholder rights. And so, of course, that ultimately the business is run by the board of directors that selects management. And there's a quasi-democracy of sorts, right, where shareholders of a public company in particular elect that board and have ultimate power to steer what that business does and doesn't do. If you are interested in Procter and Gamble doing more about deforestation in their supply chain, well, you can express that view via shareholder resolutions. You can hold the company accountable. And what's interesting, though, is the way that most American investors, just ordinary investors around the world, invest is through index funds. That structure actually it places the power to vote those shares to the so-called stewardship teams of the index fund managers. So the Vanguards, the BlackRocks, the State Streets, Schwab's, Fidelity's of the world, really those first three, the big three they're called, are actually holding voting rights for something like 20% of every public company. And historically, they've been pretty reluctant.
They don't want to rock the boat.
Yeah, they don't want, it's a lot of power. They don't want
Mm-hmm.
that power. They want the assets. They don't need to be put on blast for every single controversial vote that's out there. Increasingly, they're not really able to hide away from that power because various activist shareholders are seeing and exploiting this tremendous power and trying to harness it in favor of a sustainability agenda. So engine number one, I think, is one of those like pioneers that they saw this, they figured it out. They said, well, we're going to make an economic case for why seating these sort of pro-transition directors on Exxon's board will actually increase shareholder value. And we're going to lead a campaign and we're going to persuade BlackRock, Vanguard, State Street, et cetera, to support our campaign. And they did, and they won. That was a historic milestone. That's never really happened before, a climate-based shareholder, proxy battle. So the fact that they have since launched an ETF, which basically with the intent of curating and pursuing those kinds of campaigns on behalf of ordinary investors that can just buy this index fund, is pretty fascinating and really promising. This, in our mind, right? This is a market cap weighted fund. There's no, all the stocks are in there. It's essentially S&P 500.
Yeah.
You're not choosing what to buy, how to weight, how to tilt. There are no ESG scores. There's just shareholder engagement with those companies. How do we measure that? We don't know. There are no generally accepted metrics for what constitutes an acceptable voting record and like a sustainable one, right? That all needs to be developed. And I think particularly for your listeners in a world where if you can't quantify it, it basically doesn't or shouldn't exist, right? It's a very challenging domain to try to explain to your clients, well, we think this is important. It is not yet generally agreed upon how to measure how important and whether, and when you determine that something is in fact important, whether the investment is actually meeting that milestone. Like these things need to be written. The SEC is working on a bunch of it for what it's worth.
Yeah. And, could you maybe just touch on, how Betterment is trying to quantify that net positive impact and, that evolution and how you guys have got to where you are today and where that might be going?
Sure. So, I think we're very careful not to tie ourselves to any one particular evaluation framework because entirely new categories of sustainability are emerging, right? So it feels too early to call any one particular sort of this is ESG approved. In fact, we released in 2020, we kind of we listened to our customers. We realized that people care about things like climate and social issues specifically versus caring about some fund's ESG score. And well, that's a great foundation, right? That just to build a portfolio. We wound up releasing a standalone climate impact portfolio and a social impact portfolio so that clients can actually choose, well, okay, of course, all these issues, all kinds of issues are important to me, but if I had to prioritize them, this would be my number one issue. And then that does give you a little bit of focus to say, okay, well, you know what? Exxon may have a lot of women on their board, but they're still lagging their sector when it comes to, carbon readiness, transition readiness. how do you resolve those tensions? You kind of can't, right? It is kind of wishful thinking that a single number can somehow make a company good or bad. You have to sort of choose what you measure and drive towards those metrics. So at Betterment, we've been careful to sort of be transparent with our clients that the space is evolving, the way in which you can kind of measure whether someone is living up to what they say is still evolving. We're 24/7, like we have a team of experts that is researching this on behalf of our clients. When it comes to voting records, truly, like it is day zero, right? So what we tell our clients is the moment that something is becoming clearer, we will begin to integrate that on your behalf. Like we are your money managers. You've come to us and you've told us this is important to you. This is what we're going to do for you. It's a relationship. It's an ongoing service. It's not like a one and done, you know? So that's resonated.
That's huge. You know, traditionally for the wealth manager, you know, that has a client that says, I want to invest ESG, that wealth manager has to go out there and try to figure that out by themselves. But that wealth manager now has the ability to leverage that team that Betterment is doing 24/7 to provide really well thought out information directly to that client. And, you know, the other thing that I thought was really fascinating, and I think the same study that was released in 2020 by you all, is that, you know, women and Gen Z are more likely to want ESG than men. And we've always been a big proponent of, on the first side, that there's this huge population of women that are being serviced by male advisors that are not being serviced well. And secondarily, all the data shows that wealth managers, as well as probably accountants as well, a majority do not get the children of the clients that they're servicing, right? So not only is this a really well thought out way to start getting involved in a space that is in demand, but it's also a way for practitioners to get more clients, right? By being somewhat versed in what large swaths of the population of potentially new clients for accounting firms, wealth management firms, technology firms, to address this addressable market that, you know, isn't being really well served, if we're being totally honest, broadly across the market. You know, how do you guys, you know, was that a big pool for you guys to get into this as well?
Well, so I mean, our median client, I think, is somewhere around 35, 36 years old. When we look at clients that are choosing the socially responsible strategies, you know, maybe that's a couple of years younger, right? So that we do see there's a statistically meaningful shift, but it's already a relatively young client base. And I think it's really just a question of meeting clients where their, I guess, emotional like complexities around their money lies. You know, money is a very emotional thing. Even before you get, you know, you start injecting, you know, climate change and you know, and justice into things. So it's in some sense like that conversation between a client and an advisor is always, you know, you can pretend it's about the numbers, but it's never just about the numbers, right? Any advisor that's kind of, you know, held a client's hand through, I don't know, like the 2008 market crash, or like, you know, that so much of this is about psychology, and it's about trust, and it's about, you know, sort of establishing that kind of lifelong relationship which can endure these complexities. And so I think when it comes to values, like the younger generation, this isn't like boutique. This isn't like a little sprinkle. This is the whole game now. Like if you have no answer to how sustainable are my investments, you're not going to get that generation, period, right? You will become niche, like if at all, right? And but the good news is it is really more of a narrative than it is an answer. And I mean that like in the best possible way, because I think clients generally respond very well to, just transparency, and I think when it comes to sustainable investing, it's an advisor isn't actually revealing themselves as ignorant by saying, look, there are just a lot of things we don't know. There are a lot of gaps here, because the entire industry will tell you that. Like, we obsessively study this and we can tell you here where the gaps are. Now, I think it's really useful to also have an answer to what is the roadmap towards closing those gaps. For instance, we rank companies based on their carbon footprint. There's this concept of scope 1 emissions, scope 2 emissions, scope 3 emissions. Those numbers, so the various climate carbon based index funds that are somehow doing something with that information, they're taking that data. That is all self-reported. That is not, no big four accounting firm is signing off on these numbers, right? The methodology is all over the place. Some companies simply choose not to report it, period, right? So on some level, how can you blame really anyone, whether it's MSCI, who's trying to construct an index, whether it's BlackRock, who's using that index to construct an ETF, whether it's an advisor who's trying to build a portfolio out of these ETFs? I mean, the fundamental input to this whole system is flawed, but that doesn't mean it will be that way forever, right? Like, this chain is being assembled. On the one side, you say, clients say, this matters to me. And on the other side, well, there's the data's got to be there to actually do something meaningful about that, to express that preference. And the SEC is about to release something called the climate. It's called the climate rule, colloquially, inside the SEC, which was proposed, for comments, I guess, earlier in 2021, and is expected. The proposed regs are expected to drop any day, honestly. I think it's not getting enough attention, but it will. Many people say this is probably the most transformative piece of SEC rulemaking in a decade, because it will, if it goes as expected, it will effectively bring carbon footprint, emissions from the business's operations into the fold and require your public accountants to certify these numbers. Transforming the status quo, where it's a bunch of self-reported, who knows, you can imagine, by the way, that if you do a little bit of reasoning, who do we think is not reporting or underreporting? Probably it's not probably random. It's probably the ones that are emitting the most, right?
Yeah.
So there's just so much. I mean, you could just go to town on how unreliable this data has to be, right? But once it becomes a matter of public certification by a big four, accountant, that's a sea change in terms of the reliability of that data. So when I say it's a nascent space, I mean the quality of the data available to the index constructor, to the index fund manager, to the advisor is about to change dramatically, right? So it's okay that we don't know yet, because it's really just early innings.
We're formulating the rules of the game, it seems like, Boris.
Yeah, systemically, it is moving in the right direction. And the fact that it's not fully there yet doesn't mean it's somehow too early to start. Because the reason why the SEC has cited this in their rulemaking, they look to the asset flows that are going into these ESG funds. They say, you've got Commissioner Allison Heron-Lee in her speeches last year saying 50 billion flowed into ESG funds in 2020. They look to those top line numbers as justification for why these rules need to be updated. The fact that people are moving in off the sidelines is what is creating the momentum for this regulatory action. So all these pieces are moving in concert. For an advisor to say, you know what, you come to me as my client and you tell me this matters, and you can be a part of this change. You can help spin this flywheel, even if the thing isn't totally ready yet, and maybe it never will be. You can be a part. It's a process, and you can be a part of it.
It's a step in the right direction.
Right?
Yeah.
Yeah.
And speaking on that, Boris, I saw in one of your pieces or one of your materials, some of these diverse ETFs that are out there. There's the NACP, which I believe is offered by Impact Shares, and they track the Morningstar Minority Empowerment Index, which I think it rates companies on minority empowerment. And then there's the SHE stock ETF that allows investors to invest in female-led companies. Can you kind of talk about these various ETFs, these diverse ETFs that are being put out there?
Yeah, I mean, again, like, right, there are data issues here, right? Not all American public corporations are even properly reporting sort of like, diversity metrics. What the NACP ETF does in particular, it's based on the NAACP's methodology for evaluating, how companies, how American public corporations fare on effectively issues of racial justice, whether it's diversity, among leadership, but also how these companies, interact with their communities and their labor force, and whether or not their products are somehow, have some sort of impact. It's a pretty sophisticated methodology, and I think, it's tough to sort of like look at the output and say like, well, why did this company make the index and not this one? It's more about like you're voting for the index methodology. You're saying, you know what, we trust that the people that are thinking about this full time, that are designing these metrics, and that these metrics, by the way, are publicly available. You can look at the index construction data from Sustainalytics, which is a Morningstar company. You can, reasonable people can kind of disagree, and they're constantly iterating on this methodology. But the point is that like by putting dollars in these ETFs, you are telling the industry, this matters to me. I'm not sure exactly what this is at this point. It's a process by which we are trying to understand what kind of quantifiable methodologies make sense here, how we want to effectively, reward the leaders, punish the laggards. There's a much broader sort of like theory of change here, but the first step is just at least saying, I want to be a part of that.
Yeah.
And I think that it makes the index methodologies really the stars. Like you're voting for that.
Yep. And kind of shifting gears just a little bit away from ESG, Betterment was one of the first to automate this kind of tax loss harvesting, tax efficiency portfolio. And, we've got a lot of accountants on here that know that they're constantly having to tell their clients, hey, have you told your advisor to do some tax loss harvesting? Could you maybe talk to the power that Betterment has provided for tax efficiency and tax loss harvesting?
Sure. So as a former tax lawyer, this is very near and dear to my heart. I think, so we did launch our automated tax loss harvesting service, I want to say 2014, or it's been a while. And we've certainly like iterated on that. And I think the idea of, being able to squeeze some amount of tax alpha out of a diversified global portfolio, there'll be a year where you've got, emerging markets are getting killed, domestic is propping up the overall allocation. A couple of years later, it reverses, and suddenly like, oh, the S&P 500 is not doing so great, but check out, in the brick, allocation or some such, right? So the idea that you should be able to, in an automated fashion, just realize as many losses as you can without fundamentally, mucking up your asset allocation is one I think that advisors are pretty familiar with. Another thing that we launched a few years ago, which we call the tax coordinated portfolio, is really an automated asset location service where if given a number of accounts with different tax profiles, whether like a taxable brokerage account, a tax deferred, sort of a traditional IRA 401k, or a fully tax exempt Roth type account, people will probably be familiar with this idea of like, hey, well, certain assets just have a far better, long-term after-tax returns depending on where they sit because of the nature of the income they generate. So one thing that Betterment does, which to my knowledge, nobody has automated in the industry still to date, is we manage a single portfolio across all of your different account types. So you could have you could have a traditional and a Roth and a taxable account. And rather than just putting the same portfolio in each pro rata, we will locate the assets where they generate the highest expected long-term return after taxes. There are a lot of rules of thumb around this, but actually automating this in a rigorous way is you'll wind up with some surprises. It's not necessarily that, oh, this kind of asset always goes here. It depends. So that's another thing we've worked on we're very proud of.
Yeah, exceptionally powerful, for CPAs that have traditionally, outsourced wealth management or referred wealth management out to probably some great wealth managers out there. But, Betterment really provides a lot more certainty that there's a household approach, asset location, and tax efficiency is something that is important, right? Not just to the client, but increasingly as accountants get into this, it adds a lot of value, to say, look, we can't quantify the amount that we think this is going to be beneficial for you, but let us show you some data why asset location, tax loss harvesting could be really beneficial to you in the future. That can be a real value add for a lot of accountants.
Yeah, and one of the things that actually we're quite envious of, right, when it comes to say an advisor who is also an accountant, is there are some core principles, right, that we're able to code into our algorithms. Like, you are going to want to accelerate losses and defer gains. There are very, very few exceptions to that rule. Like, there are some, but generally speaking, that's probably going to apply to almost any client situation. However, in order to get more sophisticated and drive even more value, getting visibility into a client's full tax situation, there are a lot of accounts out there. There's only one tax return, right? Mm-hmm. It all has to flow together, and so having that visibility that you would have as the CPA for the client offers some really, really powerful, I think, strategic advantages ultimately. That an online automated service really can just kind of begin to chip away at. So we see ourselves as a tool for instance, our Betterment for Advisors business line functions just that way, right? Like, we can automate a whole host of tax features that we know are beneficial within the scope of that portfolio, but it's ultimately up to the CPA to take a broader look and say, like, well, just how much do I value this kind of loss versus this kind of gain, given what else I know is happening in my client's tax year or will happen. So that's also really interesting. The idea of like bumping in between tax brackets and how you might have marginal income actually have really unexpected impact on other pieces of income. Like, this is the kind of stuff that we'd love to automate, and someday I think there might be more tools that scratch at that, but not for a very long time.
Great. Yeah, I mean, I think we need to do a whole another episode, Boris, on tax efficient strategies and Betterment solution. I think our accounting firm audience would really love that. Thank you so much for coming on, Rob. What a great guest. We learned about ESG investing. These different types of ETFs, I'm super excited.
We were early believers. As soon as Betterment-led advisors come on, we have been huge believers. So we want to thank you, Boris, for coming on and for all the work that Betterment does. Not just for our clients and our advisors and our accounting partner firms, but for the broad industry as well. It's really been fantastic, and I think it's been a huge drive for change in some of these areas that really needed to change. So really appreciate your time and hoping to have you back on sometime soon.
Yeah, I really, really had an amazing fun time talking about all this stuff. It's not often that I get to talk about both sustainability and tax in the same conversation.
And with UBS just buying Wealthfront, Boris, you guys are the only ones left out there.
Well, that's right.
The shiniest one.
The shiniest one.
Well, we're in it for the long haul. So, these are just blips along the journey. We want to serve our clients and we want to help advisors serve their clients throughout their lives. So never losing track of that.
Love it. Thanks so much, Boris.
Thank you, Boris.
Thank you. Mm-hmm.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.